You think 2008 was bad? That was a warm-up. What's coming next makes that look like a hiccup. Right now, the world owes $315 trillion. That's over $38,000 for every person on Earth, including newborns. And here's the part they don't tell you. Over $100 trillion of that debt needs to be refinanced in the next 3 years at double, even triple the original interest rates. We're standing on a financial time bomb, and nobody's diffusing it. Supply chains are cracking, credit markets are freezing, shadow banks are overleveraged, and central banks, they're out of ammo. This isn't going to be a slowdown, it's going to be a collapse, and you're going to feel it hard. Let me show you why. You want to know just how far this has gone? Let me give you a number that should make your jaw drop. In 2024 alone, global debt increased by $15 trillion. That's more than the entire GDP of China, just added, in 1 year. And that didn't come from some unexpected war or a once-in-a-century pandemic. No, it came from business as usual. Governments spending more than they earn, corporations borrowing to buy back their own stock, and consumers swiping credit cards to survive inflation that's eating wages alive, and nobody's even pretending it's sustainable anymore. In the past, leaders at least mouthed the words fiscal responsibility. Now, they're openly saying deficits don't matter. That's the real horror show. The International Monetary Fund, the World Bank, even the Bank for International Settlements, organizations that used to be the high priests of financial orthodoxy, are now releasing reports that read like panicked confessions. They're warning of liquidity traps, interest rate shockwaves, and a synchronized global slowdown. But here's the punchline. They helped build the trap. For decades, they encouraged countries to borrow cheap, invest big, and worry about consequences later. Well, it's later now. And what's changed? The interest on that $315 trillion monster is no longer 0.5%. It's climbing, fast. According to S&P Global, over $70 trillion of this debt is now subject to refinancing in the next 24 months, and most of it will cost double or triple what it did just 3 years ago. That's not just a few weak links snapping, that's 1,000-pound steel chain snapping at once. If even a fraction of that debt defaults, it won't be a recession. It'll be a global margin call. Every leveraged institution, from banks to governments, will be forced to sell. But sell to whom? Everyone else will be selling too. That's not a market correction. That's a collapse. Now I want you to consider something no one in the mainstream media is brave enough to say. What if this next downturn is the final one? Not final as in the end of capitalism or the end of the world, although some might argue we're flirting with both, but final as in the last time governments can respond with the same old playbook. Think about it. The U.S. Federal Reserve's balance sheet hit nearly $9 trillion during COVID. The European Central Bank isn't far behind. Japan? They've printed so much yen, they now own over 50% of their domestic government bond market. That's not stimulus. That's monetization of debt. And it's only been tolerated because inflation was transitory. Except it wasn't. Inflation stuck around like a bitter ex who moved back into the house. It shredded real incomes, triggered riots from Paris to Buenos Aires, and forced central banks to jack up rates even when their economies were gasping. So now they're trapped. If they cut rates to soften the landing, inflation will explode again. If they raise rates to contain prices, bankruptcies will soar. There is no soft landing. It's either a crash or a fireball, and that fireball has a name: debt overhang. Economists have known about it for decades. It's the phenomenon where debt levels get so high that they suppress growth, even when the economy isn't in a formal recession. Every dollar spent on interest is a dollar not spent on investment, wages, or innovation. It's an invisible tax on the future. And at $315 trillion, that tax is now bigger than the global education, healthcare, and military budgets combined. We're not just out of ammo. We've been firing blanks for years, hoping no one would notice. But now the markets are noticing. The bond market, the most sober, least excitable financial sector on Earth, is starting to price in sovereign risk for countries like Italy, France, and even the U.S. This isn't theoretical anymore. It's here. Let's look at what's happening beneath the surface, because the headlines won't tell you this part. While the media talks about strong job numbers and resilient consumer demand, the underbelly is rotting. In the U.S., over 60% of Americans now live paycheck to paycheck, including more than 40% of households earning over $100,000 a year. Read that again. High-income earners can't make ends meet Because the cost of debt service, credit cards, mortgages, auto loans has exploded. Delinquencies are now rising faster than they did in 2007. Auto loan defaults just hit a 30-year high. Small business bankruptcies are up 35% year over year, and corporate bond downgrades are accelerating. But you won't hear that on CNBC, because Wall Street is still riding the high of asset bubbles that refuse to deflate yet. Real estate in major cities is still priced like 2021. Tech stocks are still trading at nosebleed valuations. Why? Because everyone believes the Fed will pivot, that Powell will blink, that the money printer will save them again. But that belief is about to shatter. Because unlike 2008 or 2020, the Fed isn't facing a temporary shock. It's facing a structural trap: high debt, high inflation, and political paralysis. The magic trick is over, and the second that realization hits the markets, it'll be a stampede. Not a slow correction. A panicked exit. Margin calls, fire sales, liquidity gone in a flash. Remember March 2020, when the Treasury market itself froze, and the Fed had to inject trillions overnight? Imagine that, but with no tools left. That's what we're walking into. And it's not just the US. Look at China. Over $9 trillion in local government hidden liabilities, property developers defaulting left and right, and a middle class that's losing faith in real estate, their main asset. Or Europe, where energy inflation and sluggish productivity are dragging the whole block into stagflation. The entire global economy is synchronized. And it's not synchronizing for growth. It's synchronizing for collapse. You want to know why this matters now? Why this isn't just another doomsday prediction? Because for the first time in modern history, every major lever of economic power is compromised. Central banks can't cut, governments can't spend, consumers can't borrow, and corporations are running out of accounting tricks. But there's something worse lurking underneath it all. The collateral is evaporating. What do I mean? Every debt instrument, from mortgages to corporate bonds to sovereign debt, is backed by an assumption that the underlying asset will hold value. But when asset bubbles are this inflated, when debt to GDP ratios are this distorted, that assumption breaks. Commercial real estate, once the crown jewel of institutional portfolios, is in free fall. Vacancy rates in U.S. cities like San Francisco and Chicago are hitting 30%. Office buildings that sold for $500 million 5 years ago are now being auctioned for $200 million and nobody's bidding. That's not just a haircut, that's a decapitation. And guess who owns those buildings? Pension funds, insurance companies, banks. Their balance sheets are about to implode, and residential real estate isn't far behind. As interest rates stay high, mortgage applications have collapsed. First-time homebuyers are priced out. Investors are pulling back. And yet prices haven't corrected yet. When they do, and they will, trillions in perceived wealth will vanish. That's your collateral gone. The same applies to corporate debt. Junk bonds issued in 2020 at 3% yields now trade at 60 cents on the dollar. That's a crisis of confidence. And once confidence goes, liquidity vanishes. It's Lehman all over again, but bigger, because now it's systemic. And here's the cruel irony. The more debt we have, the more we rely on inflated collateral values to keep the system solvent. But inflation forces rates up, which kills collateral values. It's a vicious circle. And we're in the final lap. The $315 trillion debt pile isn't just a weight on the system. It is the system. And when it cracks, the consequences won't be contained to Wall Street. They'll hit Main Street, hard and fast. This is the part where most people stop watching. Because what I'm about to tell you isn't just uncomfortable, it's existential. You've heard about the $315 trillion in global debt, the interest rate traps, the collapsing collateral. But none of that compares to the real danger. The real monster is hiding in plain sight. It's called the shadow financial system. And it's not regulated, it's not accountable, and it's not prepared. See, the modern financial system doesn't run on bank loans anymore. It runs on leverage built on top of leverage through private credit funds, derivatives, collateralized loan obligations, asset-backed securities, and synthetic products that even the institutions trading them don't fully understand. And the size of that shadow system? $675 trillion in notional derivatives. Let that number sink in. It's more than 7 times global GDP. And none of it is on balance sheets in a way you can see. None of it is insured the way bank deposits are. And none of it is backed by a lender of last resort that can step in if the system seizes up. In 2008, the collapse of a few tranches of mortgage-backed securities nearly took down the global financial system. Today, we've got hedge funds with 50-to-1 leverage playing in private debt markets with no oversight. We've got pension funds using derivatives to juice returns because they can't meet obligations in a low-growth environment. We've got banks using accounting loopholes to hide duration risk, just like Silicon Valley Bank did before it blew up in 2023. That wasn't a one-off, that was a preview. And here's where it gets even darker. Much of this shadow debt is cross-border. A European pension fund buys a CLO issued in the US, which is backed by loans from Chinese banks, which are collateralized with real estate in Vietnam. None of these entities fully understand each other's risk exposure, and when one leg of the stool breaks, the whole thing collapses. It's the financial equivalent of a viral outbreak in a densely packed airplane. Once the coughing starts, no one gets out clean. The IMF knows this. In its 2024 Global Financial Stability Report, it buried a chilling sentence in the footnotes. A broad-based correction in global asset prices could expose hidden leverage in non-bank financial institutions, triggering a disorderly adjustment. That's technocrat speak for everything blows up. And here's the nightmare scenario. Let's say commercial real estate collapses, triggering losses in private credit funds. Those funds get margin calls, and they have to sell liquid assets like US Treasuries. The bond market panics, yields spike. Suddenly, governments can't roll over debt. Interest costs explode. Central banks try to intervene, but doing so risks reigniting inflation. They freeze, markets go no bid, credit evaporates. Businesses can't roll debt. Payrolls stop. Banks close their doors. That's not a recession. That's systemic failure. A financial heart attack with no defibrillator. And don't think crypto is a safe haven either. The crypto ecosystem is now deeply entangled with traditional finance. Stablecoins are backed by treasuries. Exchanges are leveraged to the eyeballs with fiat loans. If the banking system cracks, crypto will be a casualty, not a savior. This is a house of cards built on a fault line. And we just triggered the earthquake. There is no single institution with a complete view of the risks. The Fed doesn't see what private equity firms are doing with repo markets. The SEC doesn't regulate international derivatives exposure. The BIS doesn't track all forms of shadow leverage. Everyone is blindfolded, walking through a minefield, hoping the next step won't be the last. And here's the final gut punch. There's no adult in the room. Politicians are paralyzed by polarization. Central bankers are out of ammo. Regulators are overwhelmed. And the public? The public is distracted, divided, and drowning in bad information. When this breaks, and it will, there won't be a warning bell. No time to reposition. No opportunity to hedge. Just a cascading failure of everything we thought was stable. The recession you're being told is necessary isn't a correction. It's the detonation of a debt-based financial system that's run out of road, out of tricks, and out of time.